Good evening. Doc Severson here for the Theo Night Report for Thursday, February 15th. All right, guys, we're going to start off here with the 10-year note. And as we've been talking about for the last couple of weeks, we're in a rising rate environment. What I find particularly interesting from a technical perspective is how this descending channel is being broken to the upside with a higher low here. So technically, this is a perfect breakout from here. Now, is this really heading higher? We'll have to see. But so far, the bond market thinks so. And also from a technical perspective, this is a lower high setting up on the monthly chart. And if confirmed, in other words, if this drops through here, then that is one of the first signals to a confirmed bear market, is not only just the percentage, but also from a technical pattern perspective, a monthly lower high is an extremely powerful technical signal, in this case to the downside. So the Fed's probably going to have to raise rates when it gets back together again with Jerome Powell at the helm on 21st of March. And that seems like a long way away. But right now, the probability of that occurring, that rate hike occurring, is now 83%. So is that money actually shifting out of bonds now and back into the equity markets? Well, it appears so for at least right now. Now, this is what we're seeing on the spiders, and these two horizontal blue lines are the expected move for the week. The expected move for the week. So we had a 9.4 point expected move for the week on the spiders, which is about 94 handles on the full S&Ps. You can see how far this move has gone and has completely obliterated the upper expected move, as well as the 50-day moving average. This is a little surprising, as the price had a little bit of trouble with that 50-day moving average off the first false bottom, but now we've seen that we've undercut that and actually equaled that on the full S&Ps. So let's go over to the full S&Ps here, the /ES, and you can see that kind of tweezer bottom look that we've put in over the last couple of weeks here. Remember, that sell-off started exactly 2 weeks ago right there. So this is where things got kicked off from the highs, and we've double bottomed almost in a tweezer fashion, and we're screaming higher. So now the question on the table is, are we going to see a 2014 version of a V-bottom ending up with higher highs? Or are we going to see instead something closer to what we saw in 2015 with a very complex pattern that ended up consolidating near the highs again before it failed and came back down and retested the low? Now, of course, I don't know the future. I have no idea what's going to happen next week, tomorrow, anything like that. All I'm looking at is the probabilities based on what's on the chart. The one thing that sticks to me that goes against the V-bottom is the level of exhaustion that we've had. We've had almost a historic level of exhaustion at the larger time frame charts. I don't believe that this is just going to have the energy to get up here and just V-bottom all the way up to 3,000. It certainly could. Again, I don't know what's going to happen tomorrow. The price is free to do whatever it wants to do. So don't misinterpret me saying that it can't do that. It certainly can do whatever it wants to do. I'm just looking at the probabilities here, and the probabilities based on this low level of energy, which has been overdue for some type of corrective move, is low that we'll actually see this trace out a higher high without some significant up and down volatility in the next couple of months. Now, the other thing that I will say to that is, if we are in a condition where this shot over the bow that we've seen here is doing another version of this back here in 2007. So I'll bring that up again. This is one other possibility that we're seeing right now. And to go back that far in time, I'm going to have to get off of the futures, and I'm going to have to go back to the SPX. And we're going to change this over to, well, we need more than 10 years on this guy. So we're going to have to go back to 20 years on this and go back to February 27th of 2007. So that's a long time ago. Okay, so there we go. Let's go back here to 2007. And this is what I want to show you here, is this sweet little move after this extraordinary rally that we had. Absolutely extraordinary rally that we had back here in the middle of 2006 all the way into 2007. So this is not unlike what we've just gone through. This was the most persistent rally I had ever seen until we've seen the most recent one in 2017. And then what happened here back in February, let's show this, is that we had this big scare, this big shot across the bow at the end of February in 2007. So this is 11 years ago now, 11 years ago. And what this created was a bottom. Bottom got retested after just a couple of days, so it fell down here and absolutely washed everybody out at the lows, close to the 200-day moving average, very similar to what we're doing here. And then what it did was set up with a lower high, higher low, and then exploded to the upside. Now, this is where things got really interesting because the volatility didn't kick in until 2007. So this is when we saw the real volatility actually hit the tape. So that was a big move. There was about 50 handles on this one back in February, but this is when the volatility really hit the tape. And this is when the big instability started hitting into the market. And this is really the genesis of the bear that hit in 2008. So you can see all these big time lower highs sitting up. So that is a potential possibility here for us. We may be seeing a V-bottom, which sets up with a much larger. So if you think this was big, the next one could be that much bigger. Okay, so let's recap for a second. My primary theory for what we're going to see here is we're going to see some big swings. We're going to see a lot of this volatility. We're going to see it. I have no doubt that it's going to go back up close to the highs again. I have no doubt of that in the short term. I also do believe that we're going to see another retest of the bottom, perhaps in another month or so. So we've got a couple of months. What I believe is the highest probability outcome in the near term is at least 2 to 3 months of very heavy swings up and down, completely washing out everybody on both sides of the ledger before this chart is able to go anywhere, up or down from here in 2018. But there is a possibility based on what we're seeing here in this incredibly persistent buy the dip mentality that we're seeing every single day. We've been seeing this so far this week where we'll start out the day with some kind of negative headline and shoots the futures down, or the cash index retests the lows of the day, and then we persistently buy the dip all the way through the day. That's what happened yesterday. That's what happened today. This is persistent behavior. So the other alternative is that we end up seeing an actual V-bottom here. The market shoots up to around 3,000, and then the real volatility hits the tape. Again, I still think that that's a lower probability because of the fact that we have these massive exhaustion figures here on the monthly and the weekly. Now, this is doing exactly what it needs to do to recharge this tape, this chart, as quickly as it possibly can. Because there's 3 ways to recharge. Normally, you go sideways. The very fastest way to recharge a chart is to actually go in the opposite direction from which it came. And the third way to do this, and the slowest way to do this, is just keep trending very granularly, very slowly in the same direction, and eventually it will get a chance to catch up. So right now it's doing the absolute fastest way to recharge this chart, but still needs probably at least another couple of months to go before it's going to be in good shape to trend one way or another. That is it for today's report. Thanks for listening, folks. See you this weekend.